So what's the first thing that comes to your mind when you think about debt relief and paying off your debts? And I think one of the big mistakes a lot of people make is that they overlook the real issue with paying off debt, and that is cash flow. These birds are really loud, so I'm going to roll up my window. So in order to pay off debts, especially if you're looking at car loans and auto loans particularly, and even at some point credit cards, is that you need to have cash flow built in to your budget somewhere so that you can actually pay on those loans. Most banks will not accept a credit card as a payment for a house payment or a car payment, and at some point you're going to need to pay off that credit card, and you can't just continue to use a different credit card to pay off a previous credit card. Now, there's a lot of ways to go about that, and what I've seen going around, and it's been around for a long time, it's not new, but as I talk about debt things, more of those things pop up in my feeds as well. And one of the things that's very popular is called velocity banking. Now, velocity banking takes, the principle is that you take out a HELOC and then use the HELOC to pay all your bills. And then what that does is create cash flow that you continue to pay back on the HELOC until things are paid off. So if you have a big enough HELOC, let's say you have $50,000 in debt and you have $50,000 in a HELOC credit, revolving credit you can use, you could technically put all of your debt in the HELOC that pays off all those payments, and then you continue to take that cash flow from those payments to pay down the HELOC. And then you just continue to revolve that way. And it can get to the point where you're also putting your expenses in there. And then the way HELOCs work, my understanding, of course, I'm not a financial wizard. I'm just telling you what I've learned and how I've heard of these things and how my understanding of how they work. So please, you've never been shy to correct me when I'm wrong. So please correct me if I'm wrong. But the way I understand the way HELOCs work is that you end up paying interest based on the average amount for the month that you have used in the credit of the HELOC. So one of the principles or things you do then is you pay everything using the HELOC, because you can use, many times you can get a debit card for them, you can pay them and use them for checks and everything. So you're just continually building, using the HELOC, but then paying off and then using and paying off. And eventually you get to where all your bills are paid and all your cash flow then goes to pay down the HELOC until you finally get rid of the HELOC. And that's one way to use velocity banking. Again, there's better channels that can explain it better. My only issue with it is that not everybody can get a HELOC. Not everybody has a home to borrow against. Now, there's ways you can do this using a credit card, but I would warn you and warn against doing revolving credit card issues, because it can cause more problems than it's worth. But if you are trying to pay off, for instance, a car loan, which is how I've used this before, you're trying to pay off a car loan, and the only way you can pay off the car loan is with cash. You need to have cash flow to pay off that payment. One of the things that we did, and it was, I'm going to boldly say, this is one of the fastest way I've ever used to pay something off. What we did was we put everything on our credit card, all of our cost of living expenses that could be put on our credit card, we did. Gas, groceries, insurance, etc. And then that freed up all that cash flow. That cash flow then every week went into the car loan and paid the car loan off. And then at the end of every month when the credit card bill was due, I could either pay off the credit card or I could just make the payment, which satisfied the credit card company. And that's why I say I warn against this method if you're not careful, because what you end up doing is stacking up your credit card debt, but you paid off the car. However, the caveat that goes with that is you can do that. It's just that once you're done paying off the car, you use the same principle of your cash flow to pay off your credit card, and then you stop using it. Now, we used it because it gave me, for instance, I was able to earn points with my airline credit card. Those points have helped fund 2 flights, basically, for me, which works out to be $300 a flight. So I've saved enough money using it that it kind of offset, but I never carried a balance. And you can do that with credit cards now. We use our credit cards now because we're still trying to accumulate cash. And then when the credit card bill comes due, I just pay the credit card and I still earn the points. So it's a great way to do it. And basically what happened is that if you use your credit card and just make minimum payments on it during this cash flow accumulation where you're using it to pay off debt, then as soon as you're done paying off the principal debt, the car, for instance, in my case, where you cannot use credit cards to pay your car loan, you take your cash, you pay your car loan. As soon as your car loan is paid off, you do use the same cash flow to then pay off your credit card, and now you're out of that debt as well. And then if you were free of debt, aside from, let's say, your house payment, you can turn around and do the same principle there. You don't have to use a HELOC. You can take your available credit to free up your cash flow, use that credit card to pay your monthly expenses, take the cash flow, apply it to your principal of your house every month. It's really easy if you bank at the same place, where everything's under one bank umbrella. We had everything at one credit union. It was perfect because that's where my credit card was. And by the way, we had a very low interest credit card. So even if I decided to carry balance for whatever reason, it was minimal interest payment. And then we used that cash flow to continue to pay things down. So if you had your house there, every month or every week, I could technically take all of my cash that would be allotted for gas and groceries and whatever may come out otherwise. If your weekly budget is $300, you can take that $300 every week then and put it on your house if you wanted to, because I could make payments anytime I wanted on principal, anytime. And you can do the same thing with your car and then do the same thing with your credit card. Now, if you have your bills go to different places, your credit cards are at different banks, you just finish paying off the cash flow for the car. Then you take the cash flow and put it toward that credit card with the other bank, and you mail it with your regular payment and just add the money back in, whatever that case may be. And that's a very, very fast way to pay down some debt and free up cash flow. What also works after the fact is that you continue to accumulate cash, which is what we're doing now, and then that cash gets applied to a high interest savings account. So now every week, now that everything's paid, the money that I would put away goes into that, so that I'm continuing to rack up 4 and 5% interest on the $500 a week that I no longer spend on monthly budget. And then at the end of every month, my credit card comes due, I make the payment, I get no charge, no interest, and I've moved over all my cash flow and it's made money the whole month. So it's just another way. It's kind of like the way the government uses your taxes, right? They take your tax money every week, and then at the end of 12 months, oh, you overpaid, here, we'll give you some money back. But they got to use their money for the whole time for free. Well, that's what I'm doing now, is I'm using the money. My cash flow is making money, and then I pay off my debt every month. My cash flow makes 4%, 5% every week, or as I put money in there, it's accumulating. I take the balance when the credit card is due and pay the balance, so I never get charged interest here, and I'm always making interest here. Anyway, just another trick that I've learned along the ways. I've got some other things I was going to talk about, but I'm going to stop it at this point. We're at 8 minutes, and I'm sure that's plenty. And if you have any questions or comments, I appreciate them. Leave them down below. All right, thanks for watching. We'll talk to you next time.